Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time home buyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Hello, everyone. Welcome to ICW. Today's March 18th, and to no surprise, I believe no one was surprised. No change in the Bank of Canada rate. Listen, there's a lot going on geopolitically. Obviously, the war in Iran was a big factor on what's to come, and what's to come is uncertainty. And when there's uncertainty, you just got to make sure you're defending. And I think that's where the Bank of Canada was, Sherry, more of a defensive no change because who knows what's going to happen. We know one thing, oil prices are going through the roof. What is it, $107 last time I checked for Brent, WTI $95. I think it was, 65 before this Iran war. So lots of unfortunate uncertainty, inflationary. Oil's inflationary, right? Everything's attached to oil, shipping, food, goods, everything's attached to oil. So who knows where this is going to go? What are your thoughts? Do you think this Iran war is going to last a long time, or do you think this is a few more days that it's over?
Something in between.
Something in between. Yeah. So hard to say.
I think it's going to be 90 days. I don't know. And you know what? No one knows.
Nobody knows. Well, here's what we do know. Lots going on. There's going to be about 46 slides here. We know the drill. We'll let Sherry go through her slides. If you have any questions as she's going through the slides, put them up. We'll get to them at the end. But looking forward to hearing what Sherry has to say about housing, the economy, and of course, our friends down south. Over to you, Sherry.
Well, thank you, Eddy. Hello, everyone. When we did this the end of January, I talked about volatility and uncertainty and that we didn't know what the future would bring. And as a result, there's a good deal of caution. And yet at the same time, when there's uncertainty and volatility, there's also tremendous opportunity. And boy, the world sure has changed since then, and who knows what we're likely to see going forward. But let's begin now. Yes, we are at war, a war in Iran. That now is the primary backdrop to the movements in financial markets. We have a softer global backdrop because of the disruptions and the massive increases in prices and not just energy prices. Certainly all the energy prices have gone up, be it oil, natural gas, etc. But also we've seen a very substantial impact in terms of higher prices for aluminum, higher prices for fertilizer, and the global interconnections are really quite substantial. So we got into this war, or I should say, the United States and Israel got into this war. And more recently, just in the last 2 days, Trump was asking the rest of the world to send their warships in order to help open the Strait of Hormuz, which pretty much everyone has refused to do. So that certainly will slow down the conclusion, whatever this conclusion might be. The Federal Reserve and the Bank of Canada remained on hold today, not because they don't realize that the war itself is negative for the economic outlook, but is contributing to inflation, but because with so much uncertainty, they'd rather look through the near-term developments and take another 8 weeks before we meet again to see just how long this lasts and whether it is worth tightening monetary policy to fight inflation, which will no doubt slow the economic growth, not just for Canada, but for the rest of the world as well. So Canada's job right now is to adapt to all these dramatic changes in policy. So the war in Iran has affected everyone and everything. Oil markets are bracing for lasting turmoil in the Gulf. Roughly 20% of all oil does go through the Strait of Hormuz. So many countries in Asia and Europe are now experiencing shortages of energy. Iran's new leader has vowed to keep the Strait of Hormuz closed. Attacks on infrastructure in the region have growing implications. Iran is fighting back, and not just fighting the US and Israel, but actually lobbing drones and missiles into other Arab countries in the Middle East. And the bottom line here, which is very positive, is the demand for Canadian oil is rising. Now, Canadian oil, as we all know, coming from the oil sands, is heavy oil, which is also the oil from Venezuela and from Iran. And with those two countries' oil supplies taken out of the global marketplace, the demand for Canadian heavy oil has increased. So that's one bit of good news underlying our economy. So from this chart, you can see that oil-driven inflation fears are pushing interest rates upward, and that this is unusual when an economy is slowing. But as you see from this, I captured this slide here just about 45 minutes ago. So oil prices for West Texas Intermediate, just shy of $100 a barrel at 98.34. And we've seen the 5-year government bond yield, so important for the determination of fixed mortgage rates, continues to test the 3% level. It was at 3% just a couple of days ago. It's now come off of 3%, but this is up from where it was in January. The big question is, how long will this last? And the answer to it is, we don't know. And it's not just I don't know, but honestly, no one knows, because it will depend so much on geopolitical tensions, pressures, discussions, literally all over the world. We saw in June a 12-day war in the Middle East. When this began on February 28th, I thought we'd see something like that again. A quick attack, lots of bombs dropping, to destroy the nuclear capabilities of Iran, which they said they did back in June. But here we are on day 19, and at this moment, there appears to be no end in sight. So this will continue, and for how long, we don't know. But I talked to you about VUCA when we last had this presentation, and even more so now. VUCA, as I told you, stands for volatility, uncertainty, complexity, and ambiguity. And this unsettles consumer and business confidence, which is exactly what we're seeing. Now, the US dollar ticked up since the beginning of the war, but I wanted to show you this chart, which shows that since Trump's inauguration, the US dollar is down dramatically. And the flip side of that has been the rise in the price of gold, where gold is seen as the safe haven. Now, ironically, since the war began, gold has sold off, and the US dollar, if you can look at just that little most recent development, the US dollar has ticked up. I think this is just a knee-jerk reaction. Clearly, this is not good for the US economy, but it is what markets are telling us. Now, let's look at the overall picture for Canada, because there's some real positive developments happening. Canada is resetting. Canada is proving to us that it can adapt to what was certainly unexpected changes in American trade policy. US tariffs remain uncertain. The population growth is slowing considerably. We just saw the fourth quarter population growth coming out today with a decline in population. The global conflict has pushed costs higher, slows Canadian and global growth in the near term, with strong demand for energy, metals, and other commodities. And on top of that, AI investment is supporting long-term growth. So in this period of substantial uncertainty, it's planning, not panic, that's the right approach. And I do think that that's crucial to keep in mind for ourselves and our clients. Also keep in mind that Canada has a huge global competitive advantage. We are a rich country. We have a stable government. We have a well-educated and stable population base. We are rich in natural resources. That's everything from energy to lumber to critical minerals, not to mention fresh water. We have access to the Arctic. We're a stone's throw from the richest country in the world, the United States. And tapping into this competitive advantage is what will be crucial for Canada to thrive as we move through this difficult period. Canada also has the smallest federal budget deficit to GDP ratio in the G7. So we've got the ability to maneuver. We've got the capital base necessary to make these changes. And Canada is still very important to the United States. We remain a critical trading partner to the US, but US trade has been shifting towards Mexico since 2010. So this is not a new phenomenon. What we're really concerned about is what happens to CUSMA. And the CUSMA tariff protection is a crucial fundamental for continued strength in our underlying economy. So the result is that Canada must attract new trading partners, and with Prime Minister Carney racking up the frequent flyer points, he appears to be very successful in making trade deals around the world, and deals for products that are in tremendous global demand. Countries everywhere are reducing their exposure to US policy volatility. And so as Carney went to India and to Japan and to China, the deals, the potential for trade in all parts of the world actually are very positive. And that is something that we should keep in mind underlying all this uncertainty. And Canada's trade is already shifting. Here I show you the level of goods imports from the United States. And the red line is the rest of the world, non-US countries. The blue line is the level of imports from the US. So you see, we're already buying more from non-US countries and buying less from the United States. And then looking at that from the export side, exports to non-US markets have increased, and the transition slows growth now while building future resilience. So yes, you can't replace all these exports to the US in one fell swoop with one country, but we are exporting more elsewhere, and that will continue. But our economy has slowed, particularly at the end of last year, the fourth quarter of 2025, we saw a contraction in growth, minus 0.6%. And I expect that growth will continue to be relatively slow in 2026, picking up as we move into next year. We see it most dramatically in the labor markets. Canadian employment declined by 84,000 jobs net in February. That's on the heels of a smaller contraction the month before. We've also seen the unemployment rate tick up to 6.7%. So again, even with slower population growth, we've got unemployment rising because of the dislocation in the sectors that traded most with the US. In addition, thanks to tariffs going forward and now the war uncertainty, more people expect to lose their jobs. This is also a reflection of artificial intelligence, allowing the ability to replace what appears to be quite significant numbers of workers. The employment in sectors that have been highly reliant on US exports has declined, and that's the red line here. So Canadian GDP, I do think that in the first quarter of this year, we'll see sub 1% growth, but as we move through this year, we'll tick upward, but nothing like the experience, let's say, in 2024, where growth was for a couple of quarters in excess of 3%. Now, China, as I mentioned, has been looking toward Canada now as another outlet for Canadian oil, that there's been a huge increase in China's purchases of oil from Canada, although the levels still remain relatively low in comparison to what we were shipping to the United States. So it's one example of the shift and the adaptation of Canada, but we're not there yet. We're in a period of rapid change, and we are adapting. Another big positive for the outlook is in the manufacturing sector. Canada's economy has been in a manufacturing recession for 32 months. Manufacturing, as the US has shifted more and more towards Mexico, we've had manufacturing in Canada decline. Also, Canada's productivity growth in manufacturing has underperformed, largely because we have insufficient capital per unit of labor in the manufacturing sector. And where the real opportunity for a manufacturing boom lies is the application of new technologies, new capital spending to improve the productivity and profitability of our manufacturing sector. So when you implement artificial intelligence and robotics to manufacturing, we could let smart machines do much of the routine work, reducing labor demand and reducing the cost structure in manufacturing. We would be increasing the capital to labor ratio, which would be not just promoting our productivity, but also improving profitability as well, which is another area where Canada could aptly adapt to these changes. Another positive going forward is the resumption of population growth. This chart shows you how the population numbers have come down from what was the baseline. And the reason is because the government correctly decided it couldn't allow as many non-permanent workers and foreign students into the country because of insufficient housing supply. But this was a short-term slowdown in population growth. We're not going to return to as large an influx of immigrants as we saw from 2016 until just late last year. But we will see a resumption of smaller but positive population growth, but not until 2028. So just Monday, we got the inflation data for February, and the good news is that inflation had fallen. The headline inflation number had fallen to 1.8%, and core inflation was down to 2.3%. And in fact, if you looked at the 3-month moving average of core inflation in Canada, in the last 3 months, the core inflation numbers were at 2%, which is the target. Now, that's a good thing because subsequent to February, literally the last day of the month, the war began. And since then, if we were to take a read on the consumer price index as of this moment, it would show higher than 1.8% inflation because of the rise in energy prices in other commodities, and then the knock-on effect that has on everything from food to clothing to you name it. All prices are rising as a result of just oil or transport costs are embedded in almost all products. So we'll continue to see this inflation story playing out. Now, the Canadian headline inflation fell to 1.8% year over year in February, owing to the base effects. Put simply, in February a year ago, we saw the end of the GST, the sales tax holiday, introduced by Trudeau. And so the price level rose, so year over year comparisons become more favorable. Now, the Bank of Canada's core inflation measures also, and you see it's incredible how much these core inflation numbers have come down. The Bank of Canada today, to the surprise of absolutely no one, held overnight rates steady, and so did the Federal Reserve. So right now, our overnight rate remains at 2.25%. The Federal Reserve continues to have their federal funds rate, their overnight policy rate, at 3.50 to 3.75%. So no change there as expected. But what the futures markets are telling us is that the markets are predicting the 5-year rate, the 5-year government bond outlook is about 100 basis points higher over the course of the next 5 years. Now, again, no one knows precisely what these numbers will turn out to be. But what this is telling us is that it makes floating rate or variable rate mortgages less attractive, as the expectation is for higher interest rates going forward. And you can see these other forecast curves. The first one looks at the prime rate, which is currently at 4.45%, and the forecast embedded in the futures market going forward, 100 basis points higher in 5 years' time. And then similarly, the 4-year swap yield. Now, also on the other panel, we're looking at the forecast for the 5-year fixed and variable mortgage rates. And those two are gradually increasing. So today, the variable rate loan is cheaper, or roughly 25 basis points cheaper than the 5-year fixed yield. But because of rising rates, the 5-year fixed over the forecast horizon actually provides the lowest monthly payments. Now, Canadian home sales continued to fall in early February, disrupted by that late January snowstorm, but the latter part of the month, we actually saw a pickup in home housing activity in the second half of the month, which hopefully means that as we get closer to the spring, the usual seasonal spring selling season, things in the housing market should improve, particularly given that home prices continue to fall. Now, this shows you monthly home sales. They actually dipped slightly again in February. And the new listings were down in February also, as sellers or potential sellers have been spooked by just how much home prices have fallen. We also see here that the sales to new listings edged up slightly in February, but again, this is the monthly inventory. It's just a very small amount, but well above the levels experienced earlier this cycle. So there's plenty of supply of unsold homes. Toronto and Vancouver remain in buyer's market territory. You can see here that sales to new listings are much lower than in the rest of the country. And we also know that it has been in those two markets where we've seen the largest correction in prices. So this looks at the National Home Price Index, which is also, it also creates an index that has comparable pricing on comparable types of housing, so we can compare them over time. So looking at this measure, in nominal terms at the national level, home prices are down 20% from their peak in the second quarter of 2022, when the overnight rate wasn't at 2.25%, but at a mere 25 basis points. Now, I want to just show you something that will drive home how big a decline in prices this is. These are the nominal decline, the actual dollar values in prices. If you correct these price movements for inflation, you see that real home prices are down 30% from their peak in the second quarter of 2022. This is something that first-time home buyers may not quite be aware of. The housing market is continuing its long, slow downturn. The conditions vary by region and by market segment. Hardest hit has been the greater Toronto region, as well as the condo sector in the greater Toronto region. But we have seen examples of the same phenomenon in other parts of the country as well. Now, Canada led the world in the pandemic in the boom in house prices. Nowhere else in the world did home prices rise as rapidly and home sales hit the peaks that they did in Canada during the pandemic. So now we're seeing the flip side of that, which is Canadian home prices fall 18% nominally from the first quarter of 2022. The second largest home price decline was in China at 17.8%. So Canada led the pandemic boom, so it's leading in the Iran war bust in housing. But for first-time home buyers, this is a very positive, fundamental development that's unlikely to be repeated anytime soon. We haven't seen a situation like this since the 1990s, the early 1990s, and home prices now have fallen more in the GTA in today's world than back in the early 90s. So this is important for people to keep in mind. Housing affordability is improving, even though I don't believe there will be any more rate cuts this year. Now, there's possible rate cuts if the economy were to go into recession, which I'm not predicting, but we're on the razor's edge. We've already had 1 quarter of contraction. We could have another quarter of contraction in the current quarter, but I doubt it. And that's because we are a net exporter of oil and energy generally, and those prices have skyrocketed. And so Canada does benefit from a macro perspective, even though as individual consumers filling up our car gas tanks, we're paying more and therefore tightening our belts in terms of expenditures on other things. Average prices are still very weak. They're declining still in BC and in Ontario, and now we can add Saskatchewan to that list. In the rest of the country, we've also seen a slowdown in home sales, again, because of nervousness around tariffs, nervousness about the potential for the US to walk away from the free trade agreement, and now for the potential for an extended war in Iraq. Now, homeowners have more borrowing room. This looks at the gross debt servicing ratios, and you see that they've come down both in average terms, and it's a very strong positive in that underlying pent-up demand for housing continues to be substantial. We've also seen that the situation in terms of the economy's uncertainty has led to an uptick in mortgage arrears, although these are still very low levels for mortgage delinquencies compared to the past when times were tough. And the highest level of mortgage delinquencies is in Toronto because of the collapse in the condo space in Toronto. So again, there are pockets across the country that are feeling very tough times because of their dependence on exports to the US. And mainly that's in Ontario. So immigration has also clipped housing demand because the cuts in immigration mean reduced demand for a place to live. Unsold new homes are at a 30-year high, and construction costs have surged about 70% since the pandemic. And construction costs are only going to increase further if this war continues. So again, the household formation numbers are way down, and housing starts have been roughly stable at pretty high levels, but still nowhere near enough to make up the difference in terms of what we would need to see all the housing available that's in demand. Opportunity is especially there for first-time buyers. Because of supply of unsold properties is there, sellers are highly motivated, therefore deals are to be made, and prices have fallen, especially in Ontario and BC and Prince Edward Island. So the bottom line here is, what do we tell clients? Well, for sure, the improvement in affordability will be felt most in the first-time buyer sector. And the question then becomes fixed versus variable. And we've talked about this many times before, but if certainty is important in terms of monthly payments, then locking in affordability gains in a fixed rate loan protects cash flow and makes the most sense. If, however, the buyer can absorb payment swings and can handle the uncertainty, they could consider a variable rate loan. But it requires flexibility and risk tolerance because, again, the general view is that interest rates will be heading higher as we move forward. Eddy, that completes my shortened presentation because I wanted to leave plenty of time for discussion and to answer questions and to hear other people's views.
Yeah, there's lots of questions. I thought, Sherry, maybe we can just give everyone an idea of the three different types of oil. So there's WTI, which is West Texas oil. There's Brent, which I believe is a global price. And then Canada's WCS, Western Canadian Select. All different prices, right? So Brent would be the highest, which is the global one. Probably because it's global. I don't know. I have no idea.
Based on the prices coming from the North Sea, and it's centric to Britain, but Europe in general.
Okay, are they all governed under OPEC? All three, or just?
No, they're all market driven.
They're all market driven. Okay, all right. So we have Brent, which is global, WTI, which is Texas, and Texas is usually a little bit cheaper, not much cheaper, but maybe 10%, and then Western Canadian Select is a lot cheaper, and that's because it's a heavier oil, so shipping and refining. Yeah, so it's a heavier oil, so it involves more, so it makes sense that's a little bit cheaper. Okay, and they all sort of move in lockstep with oil prices, but just, they have different price points, but they all move in lockstep with overall global oil price demand. Is that a good sum of what's happening in the oil prices?
It's yes, except what people don't realize is Donald Trump made this mistake. He said the U.S. doesn't care about the Strait of Hormuz being closed because we've got plenty of oil, is what the president said. Well, the truth is, yes, the U.S. cares because every American that goes to the gas station is paying higher prices, regardless of the fact that the U.S. is a net exporter of oil. Same thing in Canada. Canada has lots of oil. Canada is a net exporter of oil. Yet Canadian gasoline prices have moved up because gasoline prices are determined in global markets, tied to the overall price of oil. And so we're all in that situation.
Right. So, I mean, even though we're producers of oil and we don't have refineries, but we're producers of oil, we can't say, okay, Canada, don't worry, we got you covered. We're just going to sell ourselves oil really cheap and we're going to circumvent this whole global issue and just make Canadians have cheap gasoline. That's not a possibility.
Correct.
Okay.
Here's another example. I just booked a flight from a direct flight from Sarasota to Baltimore, where my mother is. And that round trip flight was just over $500. It is now, as of yesterday, $1,200.
Yeah, the knockdown effect of oil. Yeah, of course, it's going to affect travel. Oh my God, like, of course. You even think about the summertime where people get in their cars and they go, to wherever, within, 20 hours of their homes. That's going to be less because people are not going to want to drive with it affects so much. Let's get to some questions, Sherry. Matt Chan. Hey, Matt, hope you're doing well. What is your take on potential AI bubble? What should we be watching for to evaluate if AI market hype justifies current valuations in AI related companies? So Matt just glossed over this whole global issue. It said, let's talk AI. Yeah. Way to go, Matt.
Well, Matt, that's right. I mean, that's the $2,400 question because prior to the war, that's what was driving the stock market down. The concern that AI companies are overpriced, that it's too much of a bubble. They've been spending billions and billions of dollars on these data centers. Is that really necessary? I'm a big fan and believer in AI because I use it. Mm-hmm. And I can't believe how much it has improved in just the last few months, let alone the last year or two. So it is real and it is fantastic. It is so capable, it's scary. And there are companies now that are laying off, a third of their workforce or 10% of their workforce, or not hiring entry-level workers because they can get AI to do that work. We're already seeing reduced demand for labor because smart machines are replacing that labor. Yeah. So I don't think it's exaggerated, but what the stock market does with it, that's a different story. Yeah. Because in the stock market view of AI, those companies are competing with all the other companies for your money and your attention. And anything that's gone up as much as the AI sector and the hyperscalers have gone up will beg the question, can this last? Is this a bubble? Aren't we going to see a collapse? The stock market has come down because of all the tensions in the world. War may be good for the economy, or at least sectors of the economy, because of so much military spending. But it certainly isn't good for domestic spending and for consumer confidence. And that's where there's nervousness. But, I think Canada better start building some data centers fast, because we need Canadian AI that's been trained on Canadian data sets and Canadian regulatory environment. And so you can get very specific in the different applications of AI.
Yeah, and Sherry, you really pinpointed where Canada really lacks. We are once a competitor when it came to technology. We had BlackBerry, RIM, Corel in Ottawa. We had all these very tech-driven companies, and investment just kind of went away, and we haven't become a global competitor or leader in any tech. It's actually quite scary.
Yeah, and that's why I'm suggesting that that's why we need to apply this new technology to all sectors of the economy. And manufacturing, good old-fashioned manufacturing, could benefit tremendously.
Absolutely.
From AI. Yes.
Yeah, don't ignore it, folks. I mean, if you're not, heavily, at least on a daily basis using AI for, work or even personal matters, you're behind. It's not too late. That's the good news. This is still early, but you want to be involved in some sort of, in your business, personal life, using AI, definitely. Let's go to the next question. Rob Reese asks, if Canada has an increased demand for oil, how can Canada actually provide it to the world with current federal policies? Great, we are rich in resources, but they remain in the ground. How can we change that? Well, I can tell you how to change it, but I'm sure you're going to share how to change it. What are your thoughts, Sherry?
Well, we do have an east-west pipeline now, thank goodness. And that's how China is buying oil from Canada now, is getting it from the deep sea ports of British Columbia. But there's certain limitations on that. Limitations by the BC government in terms of environmental protections, which are certainly understandable. But also, transporting heavy oil is not an easy job. And doing it through pipeline is clearly the most efficient way. You can't build a pipeline to China, but to the extent that we can pipe it to the West Coast ports and then put it on oil tankers, we need to be able to do that. And we need to be able to do it in large volumes. And that's part of the kind of nation building that the Prime Minister is working on now, in terms of the list of projects that would be to the benefit of Canada's economy going forward. And those are the kinds of projects that we should be investing in.
Fair enough. Jason Nugent asks, would this not be a good opportunity to push for the Keystone Pipeline as the pipeline to the West Coast? So you just talked about.
Yes. Trump is in favor of the Keystone Pipeline, by the way. Biden was not. So, but yes, though oil will not be as important a decade from now as it is today, and clearly renewable energy is a very strong positive, and more people will be driving electric cars in the future, et cetera. But we're in a big transition period, and it's likely that those countries that invest for the future will bear the fruits of those investments. And we should be one of those countries. And because we have relatively strong fiscal accountability and prudence, we can afford to do this. In fact, we can't afford not to do this. So I'm pleased that we're in the process of massive developmental projects, in terms of both, doing deals to trade with other countries, as well as improving our own infrastructure to enable those deals.
And you had that slide that I thought said it very well: planning versus panic. And you said that the competitive advantage that Canada has. We're world leaders when it comes to that sort of country that feels safe, has opportunity. That's why everybody wants to immigrate here. It's why we can thrive through the most difficult times. Hey, listen, it's challenging. We get it. You had the other slide showing we were the best, or the country that saw the biggest boom in housing, but now we're feeling the biggest pullback at the moment. And that just brings opportunity. We talked about opportunity. I think there's a tremendous opportunity for first-time home buyers not seen in over a decade. That is good news for the economy. It's good news for mortgage brokers. It's good news for real estate agents. Get in front of those first-time home buyers. This is something that those people that are on the fence for years, some of them from decades, they finally get into the market, which is pretty exciting. Okay, Nancy asked kind of a two-part question. She talks about the upcoming midterms. What are your thoughts on that? Is there going to be some change? We saw a vote coming kind of against Trump recently in the court with the tariffs, where he thought he had that wrapped up with his appointed judges. But is this going to happen? Is this going to be his downfall? Are we going to see some pushback on his decisions if we see those midterms go the Democratic side more than the Republican?
Yes, and it's a long time till the midterms. I say that not because it really is a long time. It's November, but look at how much can happen in period. So the war in Iran is not a popular war. It's not that people don't realize that Iran was a nuclear danger, but it's that timing is everything. And I'm not clear that the leadership at the Pentagon, and not to mention the White House, are unaware of the risks they're taking. They don't seem to have been prepared for the kind of shutdown of the Strait of Hormuz and the impact that had and continues to have. And there wasn't a lot of diplomacy going on before this started. So getting out of it is a challenge. And, what's the exit strategy? Not clear at all. And
you gotta wonder if Greenland was like, whew, thank God he's focused on this Iran war, so he's not really talking a lot about taking over Greenland. And then I would imagine Cuba's feeling the same way, right?
Well, with Cuba, he keeps talking about Cuba. He thinks he can come walk in and take Cuba. Just like Cuba's a mess, I think I might take it.
Yeah. Crazy. All right, so Nancy's second part is Kuzma. So the free trade agreement, what are your thoughts? Do you think that's going to be a good outcome? What's going to happen there?
I don't know. I don't think Trump likes it. And there's an audience of one these days that seems to be what matters. But I also think that there's been enough time passing that he's learning the importance of Canada to the underlying momentum of the U.S. expansion. I mean, he gets 93% of the aluminum supply in the United States from Canada.
Yeah.
And aluminum's one of those products that are in everything too. So, and he's no longer going to buy our lumber or our oil. I don't think so. But he could well try to walk away. He certainly wants to renegotiate the deal.
Wouldn't it be now with the judgment on tariffs? Wouldn't it be in his best interest to renegotiate that deal and try to get at least a little bit more of a advantage for the U.S. without trying to, because that's what he's looking for. He's looking for, either more tariffs or a fair deal for U.S. and the Kuzma, and you can't have more tariffs. It sounds like, correct me if I'm wrong. So he's going to have to try to get the best deal for the U.S. out of this trade deal. No.
Yes, and we similarly are doing the same thing.
Right.
Best deal for Canada. So, and we aren't going to get down to the nuts and bolts of this until I think it's July, when it absolutely has to be put to bed. So, but they are meeting. Our trade representatives are meeting, and from what I'm reading, the discussions are pretty constructive. But these are not at the political level yet. These are still just at the staff level, where the reality of it all is being negotiated.
There's a lot of questions coming in, so I want to get to. We only have a few minutes left. I want to get to as many as I can here. Can you give us other perspective on rates? So what could we cause rates? You had that chart that showed sort of the next 5 years. You see an increase in rates, obviously just depending on many different factors. So the increase in rates over the next 5 years, what is the overall reason for that increase? If you were to say it's one thing.
Inflation.
Inflation. Okay, so inflation is going to be the challenge that gives rates. So if inflation does sort of come in a neutral or better, then that rate prediction is out the window.
Yeah.
Okay, that's fair. Okay. And you talked about unemployment, with AI. How does unemployment directly affect rates?
Normally lower.
Yeah.
Because normally when unemployment rises, you're in a recession or you're approaching a recession, and the central bank cuts overnight rates to boost economic activity.
Right.
And that is what would happen if the economy were moving the way it is now and there weren't a war in Iran. We saw interest rates come down.
Mm.
And
absolutely.
This war has put the kibosh on that for now. But let's say the war ended by the end of the month.
Okay.
It would still take time, maybe even a fair bit of time, to reopen the Strait of Hormuz, because they're mining the water, and there are no mine clearing vessels in place, which tells you that Israel and the U.S. were not prepared for this.
Yeah, yeah.
But it's going to take time for that to settle in. But I mean, the underlying momentum in the global economy is for a slowdown, and that normally would mean monetary easing and lower interest rates and a boost to housing, therefore. But given the war and the rise in commodity prices, we're not seeing that. But for sure, home prices are still under downward pressure in the regions where we've seen the underlying momentum decline for quite a long time. Mm-hmm. So I do think that the softness in the housing market will boost the possibility to satisfy the pent-up demand.
Oh, I don't disagree. I think
waiting on the sidelines for house prices to fall further have to realize, that's why I wanted to give the perspective, the historical perspective, that a 30% decline in real home prices is huge.
Huge.
And, the time to start looking is now, because the opportunities are great.
Yeah, no doubt. I think, as a Canadian who, wants to fulfill that house ownership dream, it's a great time. right? And I have three fairly young boys that I've never seen them look at real estate before. They are looking, which is exciting because they sit there and say, oh, you know what, I can maybe afford to be in the housing, which is amazing, right? I mean, to see that younger generation, have that affordability factor is exciting, and and think the economy is still okay. I don't think even the job losses, you haven't seen a huge increase in unemployment because immigration has kind of slowed or stopped. So there's going to be some losses of job, but overall there's going to be plenty of jobs. So yeah, there's a lot of reason for anyone to go out and buy. And by the way, refinances, we didn't talk about it today in the slides, but those refinances coming up, there's still a great opportunity to look at the value of your home and see if there's some equity there. If you need it for emergency funds, education, investment, and others, it's still a good time. Rates are not, and Sherry, you know this, right? Because you've been around a little longer than me. Rates are still decent, right? 4% is not high, guys. It is high compared to 2%, but you're comparing an emergency, state of being that they had to lower those rates because of COVID. But besides that, if you look historically, 4% is very good.
Yes.
And with house prices coming down the way they are, the affordability factor is coming back. So lots of excitement in the housing market on a refinance level, on a purchase level, and overall. So if you do want to reach out to a DLC mortgage professional, you can do that at www.dominionlending.ca. They'd be more than happy to take that pre-approval, get you ready for either a buy or look at that refinance because of your renewal and help you either way. So on that note, Sherry, thanks so much. Appreciate you. I don't know when the next rate announcement is. Oh, there it is. See, Natasha's on the ball. April 29th, so just over a month from now. What is your prediction, Sherry?
No change.
No change. The only way there would be a change if the war even ended tomorrow. Would that be possible for a change?
Economy were to slow, yes.
Economy were to slow, yeah. Okay.
And inflation, continue muted.
Well, listen, 2.25%, with a pretty good discount on an ARM or a variable rate. If you're prime minus almost anything, you're still in that 4% range. I mean, hey, nothing wrong with that. Thanks so much, Sherry. Thanks everyone for tuning in. See you next month. Take care.
Bye.